How's it, guys? Welcome back to another video. Today's video is about the difference between external and internal liquidity. Right? We're going to go through what is liquidity, what is the difference between an external and internal liquidity, how to use liquidity to form buyers, how to use liquidity as target. Right? But before going to the video, please hit that subscribe button, like, share, and share this video with your friends and family, guys. Let's go to the video. The first thing that we need to understand is what is liquidity and where is liquidity found. So liquidity is found at every swing point in the market, and it refers to a collection of orders that allows transaction to occur. And we have two types of liquidity, which is our external liquidity and our internal liquidity. Our external liquidity refers to the extreme points or swings in the market. For example, your previous day's high and lows, or your weekly highs and lows, and it also includes your long-term highs and lows of a range. What that means is, if you look at your screen here, you realize that we have this high here and we have this low here. This is our range. Then from our range, let's say this is our daily range, and we have this high and this low. So what this means is, above this swing high here on a daily time frame, we have our external liquidity, and below this swing low here, we have our external liquidity. External liquidity does not simply refers to this point here. It means just a little above the high here. That's where our liquidity is found, because liquidity is found at stops. So people don't place their stops exactly here, they'll place somewhere in this range. Similar thing with our sell side external liquidity. So this is our buy side external liquidity, and this is our sell side external liquidity. Right? With our internal liquidity is typically found in the middle of an extreme expansion, meaning swing lows and highs that are found in the middle of an expansion. What that means, if you realize from the previous example, is this is our daily high and this is our daily low, and below this extreme low here, we have our sell side liquidity here, which is our extreme external liquidity, and above this high here, we have our buy side liquidity, which is our extreme external liquidity. So in between this high and this low, that's where we find our internal liquidity. Internal means inside, so internal means inside of the range. So that is liquidity that is found inside of this high and this low. So if you look at this high, realize the market came here and made this high, and it didn't go above this high here, and it made this high, which is a lower high, and it made this low, which is a higher low. So this becomes our internal liquidity because it's inside of this range, and this becomes our sell side internal liquidity because it's above this external liquidity. So external means outside of the range. So that's our extreme point of the range, of our range. We have our internal liquidity, which is highs, swing highs and swing low, and we have our internal liquidity, which is swing highs and swing lows, which are inside of the external liquidity. Right? Sorry about that noise. Now there are some people making noise outside with some repairs. But now that we have done with the theory part of our internal versus our external liquidity, let's go to the chart and look at a few examples. Okay, guys, with our example, we're going to use the Nasdaq 100 E-mini futures on the 1 hour time frame. But before we go there, I just want to know that liquidity is found at every time frame. You can use the 6-month time frame, the weekly time frame, the daily time frame, the 4-hour time frame, the 1 hour time frame, or even the 1 minute time frame. Every swing point has a point of liquidity. So now, if you look at our chart here, you realize that where is our extreme swing points? That we have this high here, which has not been broken, and we have this low here, which has not been broken, and this makes our buy side extreme external liquidity. This becomes our external liquidity because it's outside of any range, right? And this becomes our sell side extreme low, which is our extreme external sell side liquidity. This becomes our external liquidity. So now that we have identified our sell side liquidity, which is our external and our internal, which is our external buys and our external sells, now we have to look at our internal liquidity. Internal liquidity will mean that every highs that are found in between this high and this low. So if you look at here, we have this high here, we have this high, and we have this low. So simply by just saying that, now we have realized that we have this high here, which is our swing point. Above every swing point, we have liquidity. But because this is inside this external liquidity, this becomes our internal liquidity in the form of a relative equal highs, right? This is our internal high liquidity, and this becomes our our internal sell side liquidity because it's a low which is inside of this range. It's a low which is higher than this one because it's inside of this one. Right? This becomes our internal sell side liquidity. Right? So now that we understand the two parts of the liquidity, let's see how we can use them to form buyers. How do you use these two to form buyers? If the market is here and the market is here, we have our range here. What we are looking for is, when looking at our higher time frame, we realize that we have a bias, right? So now to confirm our bias, we look at to the left, we realize that we have a break of structure to the downside here. So we expect the market to keep on breaking sell side liquidity and going down. So now our liquidity is, we have this external liquidity and this external liquidity. Because the market is going down by virtue of seeing this break of structure to the downside, we expect the market to attack this liquidity here. So now we know that the market is bearish. So this is our bias. We're looking for the market to come here. So we're looking for PDRS in a premium market so that we can sell. So wait for the market to come here and we sell, right? So now let's look at this. What happened? The market didn't take out this liquidity until it came. So this is how you use this as our buys. So now we say we are looking for sell positions, because this becomes our draw on liquidity, which, as you can see, which happened here. And now for the other thing, how do we use them as our target? If you enter here at this order block here, this order block here, and this order block here, and you take up, because our buyers tells us that the market is going to go down and attack this sell side external liquidity. You take your position here. Where is your target? Your target, you must target the liquidity that is found inside of this range, whether the internal liquidity or the external liquidity. So your order is going to be something like this. Your position is here, your stop loss above this high, which becomes liquidity to some people, and you target this internal liquidity as your first target, right? This becomes your first target. And when your first target is met here, you take partials and you target this external liquidity, because that's where we're assuming that the market is going. The market moves from four places. The market will move from external liquidity to internal liquidity. So the market will move from this liquidity to the internal liquidity. That's first. And the second one is the market will move from the internal liquidity to external liquidity. The market will move from internal liquidity here or here. The market will move from this internal liquidity after grabbing this liquidity and will go to the external liquidity. The fourth one is the market will move from liquidity to fair value gaps. The market will move from this liquidity here to this fair value gap. And the other one is the market will move from fair value gap to liquidity. So the one thing that I need to tell you guys is, you have learned from people that says that internal liquidity is found in fair value gap, which is wrong, because fair value gaps are imbalances and not liquid. What that means is, if you look at this fair value gap here, this does not contain any liquidity. Liquidity is found at every low, not in every fair value gap, because fair value gap are used at entry points, not where you place your stop losses, right? So whenever you want to determine where liquidity is, firstly look where people place their stop losses, not where people take their trades. You have to look at where people place their stop loss, not where people take their trades. So that's where you'll find liquidity, at stops, not at entries. Okay. So if you have enjoyed this video, please subscribe, comment, like, and share this video with your friends. Peace out. Till I see you next time.